Hello dear traders, my name is Elizaveta Belugina. I'm the head of analytical department at FBS and I'm very happy to start our weekly webinar. Today, as usually, we will discuss the outlook for the Forex major currency pairs. So I wish you a good mood, a good trading week, and let's proceed. We will be discussing today such currency pairs as Euro dollar, GBP USD, dollar yen, Australian dollar, US dollar. We will also speak a bit about US dollar, Canadian dollar, about gold, and maybe some other currency pairs. Our plan is the following. We discuss markets positioning, how the large speculators view the prospects of the currency pairs. We discuss important events which will be market movers during this week. We'll discuss technical factors and then we'll summarize everything and give some trade ideas. Firstly, as usually, we'll have a look at CFTC data by Commodity Futures Trading Commission. It shows us how large speculators are positioned. We can see that the overall US dollar position remains bullish. This is net position of large speculators for the US currency. And although there was some adjustment in the week which ended on Tuesday, January 10th, still the positioning in the US dollar remains steady. So some market players have closed their US dollar bullish positions on the expectations that the currency has already gained too much after Donald Trump was elected the US president. But not everyone has closed with dollar longs, and all in all, American currency still is rather solid. If we look at other currencies, we can see that there weren't many changes during the past week. All in all, we can say that investors increased both long and short positions in the euro. The overall position is bearish, but there was a slight decrease in these bearish positions on the single currency, but still the market traders are really active about euro, and euro is in favor of the speculators. On the other hand, traders cut both long and short positions on Japanese yen. And of course, as there was a big increase in short positions on Japanese yen during the past month, the decline in these short bets on the Japanese currency is more sensitive for the market. And this is why we can see that actually Japanese yen strengthened during the past week versus the US dollar especially. Otherwise, I think there weren't any big trend-setting changes in the market sentiment as far as we can judge from CFTC data. Our next point of program is US dollar index. The index which allows us to see the dynamics of the US currency versus the currencies of America's 6 main trading partners. We can see that the US currency declined for the third week in a row last week. However, we still see that it didn't slip below the support at the weekly chart, which is located in the area of 100.85, 100.50 at the weekly chart. This is the area of 2015 highs, and this area guards the way for the US dollar to the downside. So as long as we don't have the US dollar index close below 100.50 points of the US dollar index, we can't say that the overall bullish dynamics, the overall bullish trend in the US dollar is over. So we will be watching for this area next week, as the US dollar is currently a bit out of favor of the market. It is not as popular as it was in December. So we may actually see the bears once again trying to test this support level. But to my mind, the support is rather strong. If it is broken to the downside, then it will give us a strong signal that a movement is getting ready towards 98 level in the US dollar index is lower. But if we stay above this level, then some further consolidation, some further attempt to get a bit higher to the recent highs in the US dollar index is what is going to be next for the US currency. A bit more detailed view is provided by the daily chart of the US dollar index. Here we can see that currently the index is consolidating in the area of 101.50, and we have some resistance located around 102 and 103 marks. So let's speak about the highlights of the week about the economic calendar. This week is especially busy in the Forex market. We have a lot of different releases, and not only regular events, which are usual things in our economic calendar, but also some events which are rare or even unique, as I may say. We have two such unique events this week. I mean the UK Prime Minister May's speech on Tuesday and Donald Trump's inauguration on Friday. So some big changes await both the United Kingdom and the United States. Let's start our talk with Britain. And we can see that this week we will have a lot of statistical releases from the UK. Inflation data on Tuesday, labor market figures on Wednesday, and retail sales on Friday. In addition, on Tuesday, UK Prime Minister Theresa May will give a major speech on Brexit. And this is an event market players are closely watching. We have seen British pound open this week with a huge gap to the downside, and this is the impact of concerns about Brexit. Last week, when we were talking about the fate of the British pound, I repeated that despite some bright spots in the UK economic data, fears about Brexit are still the main driver for the British pound. And we have seen the confirmation of that. We have seen that although the UK economic figures were mixed last week, manufacturing and industrial production showed good gains in November. The goods trade deficit widened. We see that traders are not really impressed by the economic figures. They want to know about Brexit. We expect some comments about the fate of the UK during the World Economic Forum, which will unfold in Switzerland during the entire week. In addition, May is expected to finally uncover Brexit strategy on Tuesday. It will be just a few days before a crucial Supreme Court ruling on whether Parliament must give its consent to leaving the European Union. And the key thing the markets will be watching is whether Mrs. May wants Britain to remain in the European Union single market or in customs union after Brexit. Last weekend, May hinted that the upcoming exit from the single market, and her words definitely worsened the sentiment about the British pound. All in all, the market is more or less sure that the UK is facing so-called hard Brexit from the European Union, as the Prime Minister Theresa May wants to limit immigration and also has a rather independent stance on the fact that the UK should be out of the jurisdiction of the European Court. So as a result, according to Wall Street Journal, the only uncertainty now is to what extent hard Brexit will be softened by a free trade agreement and some other transitional adjustments between the UK and the European Union. All in all, if we have a look at the domestic political life of the United Kingdom, we can see that there isn't really a big opposition to Brexit anymore. People have gotten used to the idea that Britain will leave the EU, and now the Prime Minister Theresa May has much freedom to negotiate with the European authorities, with the European colleagues, and she'll likely have a rather strict position in negotiation, leading the UK to a really hard Brexit. So, as there are no serious obstacles for Brexit in the UK, we expect further pressure on the British pound as the market sentiment is going to be grim, and Theresa May will likely confirm this hard Brexit scenario. Donald Trump actually said that Brexit is a good thing for the United Kingdom, and of course this also doesn't make any good for the British pound. This is about data from the United Kingdom. We'll be also watching US statistics, US CPI and industrial production on Wednesday. Federal Reserve Chairwoman Janet Yellen will speak on Wednesday and Friday. And also we'll get Philadelphia Fed Manufacturing Index and unemployment claims on Thursday. This is the agenda for the United States. Currently, the market is not very sure about the Federal Reserve's approach to the interest rate hikes, although the head of the central banks, Janet Yellen, said last week that the US economy is doing well, and there were also hawkish comments from the other Federal Reserve members. Still, for now, this is not the main topic of the week, the US rate hikes. The market is more focused on Donald Trump and the various comments he makes via Twitter and in his interviews. And last week there was a big disappointment for the US dollar bulls, as they were hoping that Trump would outline fiscal stimulus measures and other steps which would encourage US economic growth at his news conference on Wednesday. But however, Trump spoke about other things. He didn't mention these policy measures. He wasn't a big talker about the economics, and as a result the US dollar declined. As a result, it has lost some of its territory. So it might be really interesting to see how Janet Yellen's speeches will go. She will deliver 2 speeches during this week, and I think that at least some of her comments must contain something substantial about the US economy and the Federal Reserve's plans for further policy. So I think that it will be important to look at her speeches. Another important event is China's GDP and industrial production statistics on Friday. We know that Chinese economic situation is a concern for the market during the long time now, and fresh data will be market movers for sure and will affect such risk-sensitive currencies as Australian dollar, New Zealand dollar, and also Canadian dollar. Japanese yen as a refuge currency, as a safe haven, will be also quite sensitive to the news from China. If the data comes below expectations, then it will be a reason for the market players to increase demand for the Japanese yen, while if the data somehow surprises to the upside, then it will be a reason for traders to buy back the US dollar versus Japanese currency. And another event I want to talk about a bit is the release of OPEC monthly oil market report on Wednesday. Although there is a lot of speculation about the organization of petroleum exporting countries, and it will be interesting to know how compliant these nations have been to the recent production cut deal, which was made in November and December of the past year. We are currently seeing oil prices in the area of $55 per barrel for Brent. And I think that during this week, oil prices will be under negative pressure. We won't likely see good news from this OPEC oil market report. And another bearish factor for oil is represented by Donald Trump's rising to power, as he is in favor of relaxing rules on the US oil drilling, and increase of the US supply will be a negative driver for the global oil prices. So Brent oil may come down from levels around $55 a barrel to the area of $53.85, $53 a barrel this week, and this negative impact on oil prices may have a negative impact on currencies such as Canadian dollar and commodity currencies. This is it. I think we will have the elements of economic discussion as well when we will be looking at the technical charts. And as we start our discussion of the technical factors with euro dollar, is I think more comfortable and more convenient to have a look at the chart while discussing the fate of the currency. Euro dollar is currently trading in the area of 106. Last week, as we have expected, the euro has managed to strengthen a bit, but in line of our expectations, we didn't see a significant move above the levels of 106.50. This is still a resistance level, limiting the euro dollar on the upside. The euro dollar was driven to the upside last week by the weaker US dollar and stronger industrial production in the euro area. At the same time, as you may notice, the single currency didn't manage to step far from its recent lows. Political uncertainty keeps limiting the bulls, and the European Central Bank's December meeting minutes showed that despite improvement in the data, low inflation still remains a concern for the euro area. This week we will pay attention to German economic sentiment on Tuesday, to final inflation for the euro area on Wednesday, and of course the meeting of the European Central Bank, the first meeting in 2017, will take place on Thursday. As the minutes of the last meeting of the ECB have shown also that a few members of the central bank's governing council rejected proposal to continue quantitative easing beyond March. But at the same time, the ECB is not likely to change its approach in January, and we expect the central bank to keep its monetary policy extremely loose. As a result, if the US dollar starts to gain strength again, the euro will probably not be able to keep on rising. So the main factors here, the main drivers of the euro dollar currency pair are the factors which come from America. So we can see that on the one hand, there was a spike to the downside on Wednesday. It happened on the disappointment of Donald Trump's news conference, when initially we have seen sells in the euro dollar, but sellers failed to settle at these low levels around 105.80, and the candle on the daily chart closed on Wednesday in the area of 105.80. The minimum was, I'm sorry, I just misspoken. The minimum was at 104.50. So on one hand, such spike to the downside is kind of thing for the bulls to recoil from these lows to the upside. It's kind of a bouncing element for the pair. However, we can see that the moving averages still have the negative slope on the daily chart, despite the fact that the pairs managed to test and even trade for now above the 50-day moving average, which is currently at 105.93. Still, we are at the upper Bollinger Band, and daily stochastic indicator is close to highs, so it doesn't have the pair doesn't have a lot of bullish momentum to develop this movement to the upside, despite the initial failure to get lower, which was seen last week. If we can switch to 4-hour chart to see the picture in greater detail, here we can see that yes, the moving averages in the 4-hour chart are rather positive, and these averages provide us the levels on which we will look for support for the euro dollar. It's 105.70, 105.44, and 105.15. Still, once again, I point your attention to resistance area, which is found here. Here in the area of 106.60. This is the area. A kind of double top we have here, which actually welcomes lower levels of the euro dollar. And we will also watch the picture on the 1-hour chart. Here I point your attention to 100-hour moving average. It was a rather good reference level for the pair. If we can trace the pair's movements to the beginning of January, we can see that these levels, this line painted in green here, and the chart actually acted as a good support and a good resistance for the pair, and was a kind of benchmark of whether we have a bullish or a bearish market for the euro dollar. And I point out to the fact that today the pair slipped below this line, which is now acting as the immediate resistance in the area of 106. And the 50-hour moving average is beginning to slope to the downside. So to my mind, the near-term pressure on the single currency is negative, and we may test as much lower levels as 105.10, 105. The weekly pivot level, the level which separates the bullish area and the bearish area for the pair, is located at 105.93. And below this mark, we will focus on the first weekly support line at 105.03. And this line corresponds to the support line drawn through January minimums. So this is the focus area for the euro dollar on the downside. On the upside, the pair has resistance at 106.20. This is the previous highs of January. And if somehow the euro manages to recover and to overcome the area of 106.60, the next levels to watch will be 107.34. This is the first weekly resistance, and for a reference, I can tell that the second weekly resistance is located at 108.24. But I don't think that such bullish scenario is going to unfold. In my opinion, the better level to focus at is located at 105, and a failure at this support line of the weekly pivot points and the short-term upward movement of the pair will open the way down towards 103.70, 103.63. These are the levels for the euro dollar. All in all, here market players may once again try to start rebuilding their US dollar long positions after some correction, and if we will see a spike higher to the area of 106.50, I would look for signals that it's time to sell the currency pair. So it may happen that we will see more attractive levels to sell the pair around 106.50, or the currency will just remain within this downward movement and continue its way from here to 105 mark. More about the British pound. Pound continues to move to the downside. It is, of course, rather difficult for the British currency to develop this negative trend at the current levels, as the pound is already extremely low. Still, some negative developments do happen in the charts. I point your attention to this formation of the prices marked by the red line. This is a head and shoulders formation, and the pair is actively testing levels below the neckline. We so far didn't see a great confirmation that the pair closed below the neckline, which is located around 1.2135. There was a gap to the downside at this week's opening, and we can see that the pair is trying to close this gap. I think that there may be some correction to the upside in the British pound, but it should be rather difficult for the pair to overcome this neckline in the area of 1.2130, and we can get an even higher levels around 1.2150. It's the more round level and the more important level. So here the return to 1.25, 150 will be probably a level to try to make some new shorts on GBP USD. Here I have the 4-hour chart. At the 4-hour chart, the moving averages are getting to the downside. Probably they don't have a great slope, a very big slope to the downside. It shows us that British pound is kind of reluctant to have a rapid decline from here, and it is understandable because British pound has already depreciated pretty much, and many analysts said that it is undervalued. But it is difficult to argue with the market. It is not wise to argue with this negative trend in the British pound. And the resistance levels for the pound to which we are referring to turn out to be lower and lower. Last week I was talking about resistance at 1.2305, 1.2410. Today I'm talking about resistance in the area of 1.2270 and 1.2318 as the top for the British pound. The weekly pivot is located at 1.2178. We are currently already at the weekly support mark around 1.2039, and the next support on the weekly chart and on the other charts, the next weekly pivot support level is located at 1.1899, and to distinguish a more important psychological level, I would say 119 is the level to watch this week for the British pound on the downside. We won't try to put our trade profits much lower once again, as the British pound is already at extremely low levels, and one should be cautious with big short positions. Despite this fact, still I believe that short positions this week are much more preferable than the long positions, just because of this fundamental picture. So we will be watching at this gap we see on the chart. Probably we'll be waiting for the British pound to return to the levels around 1.2150, 1.2170, and here look for levels to re-enter short positions and once again sell the British pound. Checking the picture in the 1-hour chart. Well, here just everything confirms our situation. Moving averages are above the price, and here limit the price on the upside. The indicators, stochastic indicator, is also in kind of normal area, and we can wait for a bit higher levels before we sell the currency. Next one on our agenda is the US dollar Japanese yen currency pair. And after some struggle above 115 mark during the previous weeks and the first part of last week, finally the bears managed to get dollar yen lower. We have arrived at 50-day moving average and the daily chart, which is located at 114 area. This is currently the main support for the price, but a lower retracement to the downside is quite possible. If we look at the 4-hour chart, we can see this triangle we were speaking about last week. This triangle was breached to the downside, and currently the pair is consolidating between 115.20 on the upside. Let's paint this resistance level in red. And some interim support was found in the area of 113.70. This is support line. So for now, we can see dollar yen in this sideways channel with 115.20 on the upside and 113.70 on the downside. Looking at MACD indicator, we can expect some stabilization, some consolidation of the pair in this area, but the signal from the moving averages on the 4-hour chart is more negative. So some time at least should pass, or some bullish driver should appear to push dollar yen back above 115.20 mark. All in all, dollar yen is probably most sensitive to the markets and reading of US dollar bullish positions, which were opened on the expectations of higher inflation in the United States. For now, the market has come down a bit about this after having no confirmation from Donald Trump that he will conduct fiscal stimulus policy. Yen also strengthened as a refuge currency, and there is another factor to take into account. It is that Japanese investors have started seasonal cash repatriation. That means more buying of the yen. Still, to have a more long-term picture in mind, we should point out that the yield difference between the US and Japan is still in favor of the United States and will likely keep supporting the greenback above 112 mark. Let's put it at the chart. So the decline and the settlement below 113.70 will surely mean that another leap to the downside will take place, but we think that the pair should find good support around 112 mark. We can have Fibonacci levels, better maybe at this chart. We can have Fibonacci levels of the pair's advance from summer of 2016 to the beginnings of this year. And we can see that the pair has retraced 23.6% Fibonacci to the downside, and the next top 38.2% Fibonacci is located just near 112 mark in the area of 111.25. And also at the daily chart we have a bullish Ishimoku cloud, which is providing support for the dollar yen precisely in this area of 111.24. So if we look at the dollar yen, we should pay attention to the following support levels, and also we should understand that some brighter outlook for dollar yen is possible on the pair's return above 115.20. In this case, the next target will be located at 117 area. All in all, the economic calendar this week doesn't contain any significant economic releases from Japan. So we will focus on the news from the World Economic Forum, which will take place in Switzerland, and Chinese statistics on Friday. So I would point out that Japan has probably the rarest statistic releases, which are important for the yen. And American data, together the factors which determine the market's risk sentiment, are the main drivers for Japanese yen. So probably it's a bit easier to trade this pair. As stronger yen and weaker dollar yen currency pair is not in the interest of Japanese monetary authorities, then we think that decline in dollar yen should be limited. So I have a fundamental belief in stronger dollar versus the Japanese yen, and believe that the current move to the downside is only a correction, and a good trader should stay active, should stay aware in order to pick up the right movement to enter the market on this correction in favor of the overall bullish trend. These were the main levels to watch for the dollar yen. Let's have a look at Australian dollar, US dollar currency pairs. I remember that when we were doing our last webinar last Monday, the pair was trading in the area just here, in the area of 0.7340. And actually after that, we saw that the bulls made a significant leap to the upside. I talked about several resistance levels which were on the way to the upside of this currency pair, and many levels were successfully broken by Australian dollar bulls, but the strongest level of resistance in the area of 0.75 still represents a great obstacle, and this level actually managed to stop the ascent of Australian currency. And we now see that there is trading actually below this point. Here at this level, we can see that there is a convergence of several resisting factors for Australian dollar, at least technical factors. These are daily moving averages, daily Ishimoku cloud, which is negative. Also, we here have the previous resistance line, previous highs, and some previous lows of the pair. So taking into account that this is a psychologically important level, it has 75 and 2 zeros after that, so this is a round level. The importance of this level is really very, very big. So I don't think that any bullish positions are possible until a clear break above 0.75 is achieved. And we should have a look at the possibility of retracement to the area of 0.74. This is the first significant support for the pair. This is close to the area of the 50-day moving average. So this will be the first level to watch on the downside. If we have a look at the 4-hour chart, we can see that the pair is slowly drifting below 0.75 mark. There will be some support of the short-term trend line near 0.7425, and the next level is 0.74. The setup of the moving averages at the 4-hour chart is rather favorable, but if we have the market once again turn into the US dollar, this moving averages won't be able to hold Australian dollar, US dollar bears, and we will see levels around 0.73 and probably even lower. So we can see at the 1-hour chart that the bullish momentum in Australian dollar has clearly declined, and short-term traders can put lines of the triangle here and look for the break of this triangle. I find that chart patterns are really efficient in the Forex market. So when we see the consolidation of the currency pair and the range of this consolidation is getting more narrow, then we'll expect that a break of this range will be coming soon, and this decline in volatility of the currency pair is often preceding some outburst of this volatility. Here we can see that the triangle resistance also lies around 0.75, so return to this area will be probably provide a negative signal, a sell signal for the currency pair, and after that we'll see the pair strengthen negative pressure on the lower line of this triangle, and then we'll see 0.7425 and 0.74 marks. Although we can't say much about Australian dollar this week, also here we'll be watching US statistics primarily, but also there will be Australian employment data on Thursday. They should have some impact on the pair as well. And once again, such factors of the global scale as demand for oil and news from China, which is actually Australia's biggest trading partner. So Chinese GDP and industrial production data on Friday will be a significant driver for Australian currency. New Zealand dollar versus the US dollar has a kind of similar dynamics, though it is not in such good shape as Australian dollar, US dollar. Here the advance above resistance line wasn't as prominent, and we can see the resistance in form of 100-day moving average in the area of 0.7146. Support is located around 0.7050. Decline below this level will open the way down to 0.6970 mark. As for the US dollar, Canadian dollar, recently the pair has tested lower levels, but all in all managed to settle above the 200-day moving average at 1.31. We will be waiting for the meeting of the Bank of Canada this week. All in all, recent data from Canada were mixed. On the one hand, trade data and business outlook for the fourth quarter were better than expected, but core inflation keeps disappointing and growth outlook remains challenged. So the Bank of Canada will likely stick to its wait and see approach, waiting for more data. Canadian dollar is, of course, in better position than Mexican peso if we are trying to judge the impact of Donald Trump's trade policy. However, it does still look vulnerable, and US dollar, Canadian dollar may try to test higher levels. Resistance is located at 1.32 and 1.3275 marks. Break below 1.31 will lead us to 1.3065 and 1.30. It is likely that after some setback to the downside, Canadian dollar will once again try to regain strength. So we will be watching for selling Canadian dollar on attempts to get higher, but taking into account the various factors which are in play, the eventful oil week, the eventful Trump week, and the eventful Bank of Canada week. Probably this is not the easiest pair to trade right now, especially as the fundamental and technical signals are not very clear here. 4-hour chart shows that the moving averages are still on the downside, favoring Canadian dollar. And all in all, the general view is that we will be selling US dollar, Canadian dollar on the best attempt to get higher. Such attempt, I think, will take place, but it won't be very sustainable. Gold is slowly but surely getting higher. Here we are actually trading some Fibonacci levels of the advance from August 2015 to the top of 2016. There was a reversal to the upside at 78.6% Fibonacci, and now we are returning higher. Probably we can get our own Fibonacci levels of decline and trade these levels. So focusing on 1,220 as resistance on the upside, and then looking further at levels around 12.50, 12.48. The setback in the US dollar has led to recovery in gold prices, but have a look at stochastics. It shows that growth momentum, further growth will be a difficult thing. So I think that this first initial resistance may prove to be rather hard for the bulls, and we may see the resumption of consolidation at least, and maybe the move to the downside in this asset. In US dollar Swiss franc, it's not a really very interesting currency pair, but here we have pretty much the same factors as for dollar yen. So the parity level around one franc for the US dollar should be watched on the downside here for dollar franc. These are the main pairs, and now we will try to sum up everything we have talked about today. So As for the summary, it will be a very eventful week. We will have some unique events like Theresa May's speech on Brexit on Tuesday and Donald Trump's inauguration on Friday. Also, we will have the report from the Organization of Petroleum Exporting Countries on Wednesday. So, and a lot of market data of high importance, central bank meetings, the meetings of Bank of Canada and the European Central Bank. So I expect great volatility. On Monday, we had a situation of lower liquidity because the US market was closed because of the Martin Luther King holiday. In this situation of low liquidity, we saw gaps formed in the euro dollar, British pound, US dollar especially. On Tuesday, liquidity is going to return to the market in full volume, and we will see that these initial movements seen at the beginning of this week will be developed in the same direction as they initially showed us. If we are talking about the euro dollar, the pair failed to make significant progress last week despite weaker US dollar and favorable data from the euro area. Great resistance is located at 106.50 mark, and only above this level the pair will get chance to get higher to 107.34. Decline below 106 will open the way down to 105 mark, and if this level is lost, then we'll focus on 103.70 area. The picture for the British pound is very difficult because of Brexit and the fact that hard Brexit becomes a more and more realistic scenario. The main resistance is located around 1.2150. The British pound can recover to this level, but here we expect new short positions. This is the neckline of the head and shoulders pattern, and the downside level to focus on is at 1.19. Dollar yen keeps correcting to the downside, but we don't think that the pair will decline significantly below 112 point because of the difference in interest rates between the US and Japan, which is in favor of the United States. Still, to overcome this corrective movement, the pair needs to get back above 115.50, and then the resistance will be at 117 mark. As for Australian dollar, US dollar, it has a strong resistance in the area of 0.75, and only above this level we may see the continuation of the movement to the upside towards 0.76. But this psychological resistance level at 0.75 seems to be very strong, so a retracement at least to 0.74 is what I look forward to. I thank you for your attention. It was a great time with you today at FX Street. So I wish you a great trading week, and we'll be very happy to meet you next week on Monday with our weekly webinar on the Forex market outlook. Greetings and all the best from FBS. This was Elizaveta Belugina, the head of market analytics at FBS. Thanks a lot and see you next time.